Am I the only one that didn't know how crucial financial statements are for understanding a business? Welcome to My Education and our series, Introduction to Accounting and Finance. Financial statements are the language of business. They paint a picture of a company's financial health and performance. Businesses use them to communicate their financial story to the outside world. Investors, creditors, and other stakeholders rely on these statements to make informed decisions. Whether you're considering investing in a company or simply curious about how businesses operate, understanding financial statements is crucial. Financial statements provide a standardized way to present financial information. They offer insights into a company's assets, liabilities, revenues, expenses, and cash flow. By analyzing these statements, stakeholders can assess a company's profitability, liquidity, and solvency. We'll dive into the key components of these statements, explore the qualitative characteristics that make them reliable, and discuss the different types of businesses that use them. Financial statements typically consist of several interconnected components, each providing a unique perspective on a company's financial position. These components work together to provide a comprehensive view of a company's financial health. The statement of financial position or balance sheet presents a snapshot of a company's assets, liabilities, and equity at a specific point in time. The statement of profit or loss, also known as the income statement, summarizes a company's revenues, expenses, and net income or loss over a specific period. The statement of changes in equity tracks the changes in a company's equity over a specific period, showing how equity is affected by factors like profits, losses, and dividends. The statement of cash flows reports the inflows and outflows of cash from a company's operating, investing, and financing activities over a specific period. Accounting policies are the specific principles, methods, and procedures that a company uses to prepare its financial statements. Explanatory notes provide additional details and disclosures that help users understand the information presented in the financial statements. Each of these components plays a crucial role in providing a complete picture of a company's financial performance and position. The International Accounting Standards Board, or IASB, plays a crucial role in ensuring consistency and transparency in financial reporting globally. The IASB defines financial statements as a structured representation of an entity's financial position and its financial performance. The IASB's objective is to develop a single set of high-quality, understandable, enforceable, and globally accepted financial reporting standards. These standards, known as International Financial Reporting Standards, or IFRS, aim to enhance the transparency, comparability, and credibility of financial statements worldwide. By establishing a common language for financial reporting, the IASB facilitates cross-border investment and reduces the complexity and cost of preparing financial statements for multinational companies. The IASB outlines fundamental qualitative characteristics that make financial information useful for decision-making. These characteristics ensure that financial statements provide relevant and faithfully represented information. Relevance is paramount. Financial information is relevant if it can influence the economic decisions of users. Relevant information helps users understand past performance, predict future outcomes, and make informed decisions about resource allocation. Materiality is a key aspect of relevance. Information is considered material if omitting it or misstating it could influence the decisions of users. The materiality threshold varies depending on the nature and magnitude of the information. Section 5. Fundamental qualitative characteristics. Faithful representation. Faithful representation ensures that financial information accurately reflects the economic substance of transactions and events. Faithful representation requires financial information to be complete, including all necessary information for users to understand the economic events. It should be neutral, free from bias in selection or presentation, and free from error, meaning the information should be accurate and reliable. However, achieving absolute precision is often challenging. Estimates and judgments are inherent in financial reporting. The goal is to provide information that is as accurate as possible within the constraints of estimation. Section 6. Enhancing qualitative characteristics. Comparability. Enhancing qualitative characteristics further improve the usefulness of financial information. These characteristics make financial statements more comparable, verifiable, timely, and understandable. Comparability enables users to identify similarities and differences between different companies or different periods for the same company. Investors need to be able to compare the financial performance of different companies to make informed investment decisions. Consistency in applying accounting policies over time and across companies is crucial for comparability. Changes in accounting policies should be disclosed and justified, allowing users to understand the impact of these changes on the financial statements. Section 7. Enhancing qualitative characteristics, verifiability. Verifiability means that different knowledgeable and independent observers could reach a consensus that the financial information faithfully represents the economic events it purports to represent. Verifiability enhances the credibility and reliability of financial information. There are two types of verifiability: direct verification, which involves directly observing or confirming information, such as counting inventory, and indirect verification, which involves checking the inputs and calculations used to arrive at the reported information. Audits by independent auditors play a vital role in providing assurance about the verifiability of financial statements. Section 8. Enhancing qualitative characteristics, understandability. Understandability means that financial information is presented clearly and concisely, making it accessible to users with a reasonable understanding of business and accounting. Financial statements should be prepared with the needs of the primary users in mind. While some complexity is inherent in financial reporting, unnecessary jargon and technical language should be avoided. Clear and concise language, logical structure, and appropriate use of tables and charts can significantly enhance the understandability of financial statements. Section 9. Enhancing qualitative characteristics, timeliness. Timeliness refers to the availability of financial information when it is still relevant for decision-making. Outdated information is of limited use to investors and other stakeholders. Companies are typically required to prepare financial statements on a periodic basis, such as quarterly or annually. Delays in reporting can hinder stakeholders' ability to make informed decisions. Timely reporting allows investors to track a company's performance, identify trends, and make timely investment decisions. Moving on to who uses financial statements. Financial statements are essential tools used by a wide range of stakeholders to make informed decisions about a company. Investors use financial statements to assess a company's profitability, growth potential, and risks before making investment decisions. Creditors rely on financial statements to evaluate a company's creditworthiness and determine loan terms. Management uses financial statements to monitor performance, identify areas for improvement, and make strategic decisions. Employees may use financial statements to assess job security, negotiate compensation, and understand the overall health of their employer. Government agencies use financial statements for tax purposes, regulatory oversight, and economic analysis. The information presented in financial statements helps these stakeholders understand a company's financial position, performance, and cash flows, enabling them to make more informed decisions. For the conclusion, financial statements are the cornerstone of financial reporting, providing a standardized and structured way to communicate a company's financial story. By understanding the key components, the IASB's role, and the qualitative characteristics that make these statements reliable, anyone can begin to decipher the language of business. Whether you're an investor, a creditor, a manager, or simply someone looking to improve your financial literacy, grasping the fundamentals of financial statements empowers you to make more informed decisions. As you delve deeper into the world of finance and accounting, remember that continuous learning and exploration are essential for staying ahead in the ever-evolving landscape of business. Thank you for watching. If you found this video helpful, please like and subscribe to our channel. Stay tuned for more videos in our Introduction to Accounting and Finance series.